Nvidia just reported an earth-shattering $68 billion quarter, crushing estimates, and the stock immediately tanked 6%. At the exact same time, the largest Middle Eastern military operation in a generation is threatening 20% of the world's oil supply, sending shockwaves through the global logistics network. The traditional rules of capital allocation are breaking down in real time. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. We are starting with the bullish news. The defense and energy windfall. Operation Epic Fury is a massive, coordinated strike against the Islamic Republic of Iran by the United States and Israel. This represents the largest regional concentration of American military firepower in a generation. While conflict creates geopolitical anxiety, it acts as a massive multi-year demand catalyst for the defense industrial base. Weapon systems are no longer just one-time purchases. They have evolved into multi-decade ecosystems. According to a recent report, ongoing maintenance and critical software updates now account for roughly 70% of a major weapon system's lifecycle cost. This creates a highly durable, recurring cash flow for defense contractors. Lockheed Martin is currently supported by a record $194 billion backlog, with their F-35 program alone accounting for 26% of 2024 sales. Similarly, RTX Corporation boasts a $268 billion backlog. Concurrently, domestic energy producers like Exxon, Mobil, and Chevron are positioned for extraordinary windfall profits. The immediate geopolitical risk premium injected into global crude pricing will drive aggressive margin expansion in their upstream operations. The OBBBA and domestic metallurgy. During the State of the Union, the President introduced the One Big Beautiful Bill Act, or OBBBA. This legislation enacts profound structural changes to the U.S. tax code. It eliminates federal income taxes on tips, overtime pay, and Social Security income. It also aggressively raises the standard deduction to $32,200 for joint filers. The average taxpayer is modeled to see a $3,813 reduction in tax liability in 2026. This guarantees a tangible increase in discretionary income for working-class households. Simultaneously, the administration invoked Section 122 of the Trade Act of 1974 to slap a 15% universal tariff surcharge on global imports. While highly controversial globally, this acts as an impenetrable structural moat for domestic heavy industry. Steel producers like United States Steel and Cleveland-Cliffs are completely insulated from foreign price dumping. This allows them to rapidly expand domestic market share and exert tremendous pricing power, driving outsized returns for industrial equities. If you want to stay ahead of these rapid market shifts and protect your portfolio, hit that subscribe button right now to join the Coffee Break Capital community. Now, shifting to the bearish news dominating the broader macroeconomic environment, the Middle Eastern energy shock. The kinetic conflict in the Middle East has immediately disrupted regional energy infrastructure. In a precautionary move, Israel halted production at its offshore natural gas fields and shut down specific operational units at its 197,000 barrel per day Haifa oil refinery. However, the most severe global macroeconomic threat is the potential closure of the Strait of Hormuz. This narrow maritime choke point is responsible for the daily transit of up to 20 million barrels of crude oil, condensates, and refined products. That represents approximately 20% of total global liquid oil consumption. If these flows are disrupted, U.S. retail gasoline prices are projected to jump to between $3.15 and $3.50 per gallon almost instantly upon market reopening. This energy-driven inflation tax heavily drains consumer spending power. Furthermore, commercial aviation is paralyzed, with airlines like Delta and United facing indefinite route suspensions and skyrocketing jet fuel costs. That universal 15% import surcharge is creating a violently bifurcated equity market. Just days before the State of the Union, the U.S. Supreme Court struck down the administration's previous global tariffs. This judicial ruling invalidated billions in import taxes, leaving U.S. businesses demanding up to $175 billion in refunds. Undeterred, the president invoked Section 122 to implement the new 15% levy. This brings the effective U.S. import tax rate to 13.7%. Companies like Walmart, Target, Amazon, and Home Depot are thrust into a lose-lose scenario. They must absorb the margin-crushing import tax or pass the cost to the consumer, which destroys demand. Home Depot's CEO explicitly warned that this will inevitably lead to necessary price adjustments. Additionally, the Section 122 authority strictly expires in 150 days on July 24, 2026, creating paralyzing uncertainty for corporate forward guidance. The structural integrity of the equity market has rested heavily on the AI capital expenditure cycle. Nvidia just reported a massive $68.12 billion in quarterly revenue, up 73% year-over-year. Yet the stock plummeted over 6% following the report. Institutional investors are terrified of severe concentration risk. Currently, 90% of Nvidia's data center revenue comes from just 5 major cloud hyperscalers. If downstream AI applications don't monetize fast enough, this immense hardware spending cannot be justified. Compounding this volatility is a rapidly deteriorating macroeconomic backdrop. U.S. GDP expanded at a tepid 1.4% in the fourth quarter of 2025. Meanwhile, the core personal consumption expenditures price index climbed to 3.0% year-over-year. The producer price index also surged 0.5% in January. This stagflationary cocktail has trapped the Federal Reserve. Federal Reserve Governor Christopher Waller argued for rate cuts due to a weakening labor market, where payroll gains fell drastically. But the Fed cannot aggressively cut rates without pouring gasoline on entrenched inflation. The financial system is currently transitioning into a regime characterized by severe cross-asset volatility and intense sectoral bifurcation. The concept of investing in the broader market is temporarily obsolete. Capital is actively abandoning index-level exposure to seek refuge in highly specific, defensively postured enclaves like defense contractors. The global market must immediately absorb and price in a devastating, dual-pronged inflationary shock. First, the 13.7% effective import tax functions as an unavoidable consumption tax. Second, the disruption of the Strait of Hormuz threatens a parabolic spike in global energy prices. These two distinct forces will synergize over the coming quarters, completely paralyzing the Federal Reserve's ability to lower borrowing costs. For the technology sector, this higher-for-longer yield environment will severely discount future cash flows. Conclusion: the structural integrity of the equity market in 2026 relies almost entirely on a fragile thesis. The ultimate question is whether the working-class consumer, newly bolstered by the $3,813 average tax reduction provided by the OBBBA, can outspend the aggressive compounding inflation tax levied by global geopolitical conflict and universal tariffs. This information was compiled from various sources across the internet and is not intended as financial advice.